Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend and friend of the channel, Matt, the mortgage guy. How you doing, buddy?
Doing great, live from Las Vegas.
Yeah. So you know what? You and I called something, gosh, 6 months ago. We said refi demand would eventually collapse 75%. It was down 78% this morning, according to Mortgage Bankers Association. So I just wanted to kind of pick your brain and kind of talk about the future again. And as an outsider, I can just generally say, hey, I think it's going to be smaller, right? We're seeing layoffs and all of that. So that's kind of a layup. I think you have insight that it's really going to be changing and evolving, not only getting smaller, but getting leaner and meaner. So what's going on, you think, in the mortgage market over the next, I don't know, 6 to 12 months?
Yeah, I mean, we've already started to see it, and it makes sense. When I say it out loud, people will go, okay, that makes a lot of sense. As the market shrinks, as competitive and competition gets fierce, the big boys are going to win. Some of the smaller fish are going to go out of business or consolidate with other small fish to create something that's sustainable through a tougher market. Nobody's should be lying and saying like the next 12 or 24 months is going to be easy in mortgage. It's going to be hard. When you come off of back-to-back championships and, some of your star players lose, all the refinance is gone.
Yeah.
And so we're starting to see some interesting stuff too. The HMDA data on mortgage applications, I didn't know they were collecting cost data, but apparently they've been collecting cost data, which shows you do a mortgage in the retail channel, it might cost $8,000 or $8,500. I don't know the exact figures, but I'm gonna look it up for a video that I'll do on my channel. On the broker side, it's like $2,000 to $2,500. So it's cheaper to do a loan on the broker side. So the brokers pass that savings along to consumers. They're doing it faster and cheaper. Not only are, all these consolidations happening, but I'm seeing more consumers, more loan originators moving over to the broker channel because they can offer the same product at a discounted price, right? And so besides the moving and shaking of companies, as the broker channel has grown, from its low of 8 to 10% of originations, I think we're in the 20s now. I see that growing even more. And then I read news from, the CEO of Wells Fargo that says, hey, we're going to downscale our mortgage operations. We're going to shut down, some of our offices in different metros and whatnot. They have got so many other things they make money off of. They've realized they're no good at mortgage. Sorry, Wells Fargo, but none of the big banks, like old antiquated bank systems are just not.
No, they're not built for the new environment.
And so over the next few years, it'll be interesting to see, smaller companies go out of business or consolidate. Low producing loan originators, the same. They're going to either go out of business, do something else, join a team as a junior LO or whatever the case may be. So all that stuff is going on. And then with margin compression and competition and other things going on, I think the broker channel grows, gets to 30% plus.
Probably, yeah.
There's a little bit of shrinkage in retail and then a large shrinkage on the bank side.
Yeah.
Partly because they just don't want that, right? They can do credit cards and business loans and all the other things that make them money and that they're known for.
Right.
And, mortgage for banks, from what I've seen, are just to retain so they get those other services. They don't really want to write them.
Yeah. Yeah. The other thing I think that's interesting, I wish I remembered the company. There was another very popular YouTube channel that talked about a mortgage originator who just went out of business or bankruptcy. I forget the name. But basically, there's a lot, or at least that video was kind of pushing the idea that, oh my God, look, banks are going to go out of business just like last time. Washington Mutual, Countrywide, IndyMac, WAMU, it's nothing like last time, right? We're not talking about banks. We're talking about originators, right? These don't have loans or they don't have savings accounts and checking accounts and things of that nature. But like companies that were built to be loan originators, some of them are going to go out of business, right? You were built for a model where you might do 100 million in loans and now you're going to do 35. Your cost structure is all out of whack. You should go out of business, right?
Right. Yeah, that's the thing too, is a lot of folks have evolved and they've changed business structure and they've done the things that make the cost to originate a loan $2,000, $2,500. The other ones, where it costs so much, you can't have all that cost built in, expect the consumer who now has access to way more than they did 10, 15 years ago, as far as like, data and being able to say, oh, I don't think 6% is a good rate for this 5% down conventional. Matt can do
Yeah.
it on the broker side for 5.25. Those folks are going to have a hard time in the next 12 or 24 months.
Yeah, I'm trying to remember the video. I watched it last week. I think it was another point in that video. They were talking about Loan Depot. Loan Depot is a public company, right?
Correct. Yeah.
Yeah, I think they were trading at $1 or something like. They're really cheap.
Yeah.
You know
And
what?
that, I mean, and that too, Loan Depot is a big company. Loan
Yeah.
Depot is a big, strong company. If they ran into trouble, that would be scary. But I wouldn't be surprised, right? Because
Right.
like I just hired somebody to help with setting up files, like high quality.
Yeah, they're $1.43 stock.
Yeah. High quality people are being let go every day from these companies that they have to do layoffs. They have to get as thin as possible just to be able to compete and survive.
Yeah, but I want to talk about Loan Depot because again, the story in the video that I watched was basically, hey, Loan Depot's just like another big bank, and Loan Depot's going to go out and it's going to be a cascading of horrors. And I don't know Loan Depot's business other than what I researched in 20 minutes, but basically they're a loan originator. They don't have savings accounts and checkings accounts. They're not having CDs. They're not a bank. They're not Wells Fargo. They're not Citigroup. They're not JP Morgan, right?
Right. They're just a loan originator. I'm almost certain they have a retail side and a
Probably.
wholesale side. So they do
Sure.
both.
Yes. But they're not a traditional bank.
Right.
So when popular folks are saying Loan Depot's just like Wells Fargo, that is factually incorrect and misleading.
Yeah. I mean, and it's funny you mentioned that, Mike, because I can't remember what I saw, but it was like this company consolidated with this company filed for bankruptcy, this company did this. Like the small players, loan originators are going to consolidate or go out of business and all that stuff. But to your point, people were trying to compare that to the explodometer.
Yeah, I remember.
The crash.
Yeah.
Where it's like this every day you get news of somebody else going out of business.
Blowing up, yeah.
Not quite the same, but
no.
But
you're going to have, again, so when I look at the mortgage origination business, we talked about this months ago, right? You did $6 trillion or whatever it was last year. You're going to do 3.5 this year or something really. And guess what? The business will be smaller. Right. The overhead that was built to run 6 trillion is not the same overhead, not the same companies that you need at 3.5. It's just not. The industry will be smaller.
Right. Yeah. I think it's like 4.2 down to 2.5. So
yeah,
it's a 40% reduction, which, purchases are going to be down slightly, but not much.
Refi's down 80.
Gone. And so like all this humongous expansion where there's lenders, Mike, that I talked to the guy at Home Point. They went from 250 million a month, and they're big. They're like number 2 in the nation, to 10 billion a month. They 40x'd their production. So like average year, and then 2020, 2021, those years were like, we shouldn't even be comparing. Like we're going to expect to have 4 trillion in originations every year. Those were outliers. Now we're back to reality.
Yeah.
And 2.5 trillion is a pretty gosh darn big.
Yeah. If you remove 20 and 21, 2.5, 2.6, that's, within 10% of kind of normal range, right?
Yeah, exactly. Yeah. I think actually 2022 was projected to be bigger than 19.
Wow.
So,
okay.
Larger than average year, even though everyone's like, oh my gosh, down 40%. What's going to happen? Well, all the extra staff that you had to get to do all this refinance, and that goes from like every level, from company, to regions and branches, even to the original, like the loan officers that had 3 assistants maybe only need 1.
Yeah. So at the end of the day, I was really bothered by a video that was trying to connect loan originators with Washington Mutual and
right.
These other institutions that were real banks. A loan originator who was built, even if they're public, it's not a bank. It's just not a bank. And to have people say that it is it's not helpful. But again, I think the industry is smaller. I think it's really insightful that Wells Fargo would make an economic decision, right? Charlie Sharp, who I think is the CEO, is like, hey, we're not good at it. He has enough problems fixing the bank. He's true. Like, that's a lost leader for us that we just don't need. Let's do something else. So again, I think the mortgage industry has 12 to 18 months of pain. It'll come out leaner and meaner on the other side of it.
The good news for the consumer, everyone's going to compete. So you're going to get the best deal. Also, all the people that aren't very good at it will get out of the business because they won't be able to survive. So you're going to have the best originators writing you the best loans with the best terms with the best companies.
That's awesome.
It's good for consumers.
I agree. And if somebody wanted to reach out to you and see what's going on, how would they do that?
go to greatmortgagebroker.com, fill out the form, let us know where you're at, how we can help, and we will be in touch.
And you also have a great YouTube channel, which is?
Oh yeah, go to Matt the Mortgage Guy on YouTube. 650 plus videos. It's really cool when I hear somebody go, you know what? I just stumbled across your channel. I watched 24 videos yesterday. I learned so much.
That's
from
awesome.
from other loan originators to consumers, everybody in between. I want to get back to some of the true educational content that's on there, which so many people want what's going on in the market and all that other stuff that I've got to mix that into. But
Yeah. It's there's so much changing. It's hard to stay current and educated. I get
right,
it.
yeah,
It's tough
and
to
then
do.
I throw in a video where it's talking about restricted stock unit income and other stuff.
Yeah.
It's just not as exciting.
Yeah.
It's good education. So if there's a question that you want answered on the mortgage side and you type in that question, Matt the Mortgage Guy, and I don't have a video on it, ping me and I'll make you one.
There you go. Thanks, buddy. I appreciate you.
Thanks, Mike.
Mhm.